Hi, and welcome to PlanStrongerTV. I'm your host, David Holland. On today's program, we're going to talk about the things that you must do, you really should do, before you start investing. Let's get to it. All right, welcome back. On today's program, I want to dig into the things you need to do before you start investing. You say, well, what do I need to do? Well, there's a lot of things that are very important to do before you start actually investing your money. You know, with so much focus in the world and in the United States especially on investing, you should do this, you should do that, you should do mutual funds, you should do an annuity, you should be in real estate. All this talk that's constant, and it comes at us from all different sources. There's like this preoccupation with investing. But the truth is, there are some very important things that we should do before we invest. So we're going to get into those. There's certain steps that we should take to prepare ourselves so that when we do invest, we can be a long-term investor. So just a couple of examples. Having a cash emergency fund, having the proper insurance, having your legal affairs in order. Taking steps to get these things right before you start investing will help you stay on the right track and make you, ironically, a better investor. So we're going to dig into this, make sure we talk through each of the things that are essential and walk through that in a detailed way, and I think that will help you plan much stronger. Let's get to it. All right, welcome back. So we're going to do an unplugged version, maybe like an acoustic version of PlanStrongerTV today, because I really want to dig into the subject of what you need to do before you invest. There is so much attention given in the United States, and of course around the world as well, to investing. Everybody's anxious to invest. Of course, those that provide investment and other financial products to you, the consumer, are anxious for you to invest as well. So with all of that focus on investing, buy this, buy that, we've got the best thing for you, all of that advertising and all of that focus, it's very easy to overlook some of the basic things that you should do before you invest. So I'm gonna ask you to think about some of these things, and if you haven't done them, please do them so that with your investing, that can fulfill its purpose and not get derailed by some of the other things that could happen that could mess up your investment plan. So I'll give you some examples. This is not an all-inclusive list, but these are some of the essential parts of an overall financial plan that really should be done and be given consideration and focus before you invest. So here they are. Cash emergency fund. Oh, that sounds boring, David. Well, it is a little boring, but it's essential. Right now, and for many years to come probably, we're not going to see a lot of interest on cash sitting in a money market or checking account at the bank. That's okay. It's okay not to make money on that portion of your total plan, because what's most important about that money is that you have liquidity and that it's a stable value and that you can access it quickly. So liquid, accessible, and stable value. And we live in a country where you do not have to go to the bank with an armed guard that you've hired to escort you to get your money. So that's the price of freedom, that our banking system doesn't pay a lot of interest on cash. All right, how much cash? Because I know it doesn't make anything, so we don't want to have any more there than we need to, because we want our other money to be more productive. How much? Well, 5% of your total assets would be a place to start. So take your total amount of money you have in investing and say, all right, I've got, and I'll just do some simple math. If we have $100,000 that is in your investment account, I would think that means then that you should have about $5,000 liquid. So that's one way to do it. And these are just different ways of looking at the same question. How much cash? 5% of your total assets. Or 6 to 9 months living expenses. Or Add up all the things that can break, all the things that can go wrong in your situation. Deductibles on insurance, how much will it cost to fix my car. Try to add up all the things that might go wrong and then kind of assume that they all happen at the same time. And what I would do is I would look at those numbers and pick the one that's the most. And if that means maybe you need to have 8 to 10% of your money in liquid money, that's okay. Again, the purpose of doing that is that you can get to it quickly. Well, you say, well, I don't know if I want to keep that much money liquid. I can get to other money if I need to, right? I've got an investment account. I can get to that. Sure, but here's the problem. What if when you need cash, the universe conspires against you and the stock market, which is where your money's invested, let's say the stock market's down 20, 30, or 40%, but you need a large chunk of money. Well, you're going to have to sell more shares to get the same cash, and that's really going to cost you in the long term. So if you have, though, cash sitting in the money market and you can access that, then you can get to that and not have to draw from the investment account while it's down. Now, the other option people look at is, well, I could borrow the money. Sure, if you have an existing line of credit already established, which I recommend, that could be a solution. But you are going to have to pay interest on that when you borrow it. Now, if you don't have that money already available through the line of credit and you have to borrow money quickly, I can bet you that the terms may not be as favorable as if you had gotten that money already positioned and ready to go. So make sure that as you think about this, that you have enough money to get to from cash in the bank, lines of credit, and places you can go to access that cash and not have to disrupt your investment plan. Now, the next thing I want to talk about, I mentioned before, insurances. It's really important to have adequate insurance for your situation, your age, and stage of life. So if you are early in your career and you're on the front end of this, then the more important things are health insurance, life insurance, disability insurance. You want to make sure you have the proper insurances in place. Well, when you get older and as you transition through life, those things that were more important on the front end, of course, are going to become not as important, or other things are going to take its place. At 65, we can go on Medicare, but we still might want a Medicare supplemental plan. We are going to reevaluate our life insurance, whether we need to keep that or not, or maybe a different type of insurance. And we also are going to take a look at long-term care insurance. So our needs for insurance will change, but what doesn't change is the need for insurance. The types will change, but to have the proper insurances in place doesn't change. Now, you say, well, but I really want to invest that money. I'm wasting money by putting it toward that or this, and I could be investing that money. Sure, you could, but real simple example, what if you don't have health insurance or you don't have long-term care insurance and you have a major need for that insurance? Guess what? That investment money is going to have to be liquidated. So what was the point of investing if you end up having to liquidate that money and use it for the need for whatever the insurance might be at the time? So have to have the right insurance in place to protect your investing plan. Now, the third thing I want to talk about is debt. What if we have debt and we're thinking of investing? This is probably one of the more important things that I see that a financial planner can really help somebody think about properly. If you've got debt and you're thinking about investing, or you have debt and somebody is talking to you, maybe it's a financial person, about investing your money, I want you to slow down and think about what's really best for you. And I'll give you an example. Let's say that you have a credit card, or you've got a mortgage, or you've got some other obligation, auto loan, and you've got some cash in the bank, and you're thinking about, or you've been approached about investing that cash. The first thing we should look at is, how much is that debt, and what's the interest rate on it? And what's the cash flow requirements for that debt? How much are you having to pay every month for that debt? If you've got a credit card that is costing you 9 or 10%, stop, don't even think anymore. This is a simple one. There's not much thought required here. If you've got a credit card with an outstanding balance and it's a high rate of interest, anything over, say, 5 or 6%, really should pay that off before investing any money. Same with a line of credit that's outstanding. If you've got a line of credit that you've pulled on and you owe on that line of credit, before you invest, pay that off. You say, but yeah, the rate's low. Well, it might not always be low. The line of credit typically is going to be tied to the prevailing interest rates. And if interest rates go up, then that line of credit is going to cost you more. So get your financial house in order before investing. Protect yourself first. Make sure your finances are secure. Get these things paid off before you go investing. Now, we start talking about mortgages and whether it's appropriate to pay them off or not. That's kind of a different subject because you potentially could be getting a tax deduction or it might be a very low rate. But generally speaking, if you've got debt, pay it off. And if you've got credit cards or you've got multiple sources of debt, types of debt, start with the highest interest rate debt, pay minimum payments on everything else, and pay that down first, then turn to the next one with the next highest rate, and the next one after that. Whittle these down and get them paid off so that when it comes time to invest, you can be more free and more comfortable. And here's the other ironic part of having your debt squared away before investing. It makes you a better investor. If your credit card or other form of debt, there is a call for it to be paid off, lines of credit may not be extended. They can be frozen. There can be a maturing of the line of credit. I saw a person not long ago have a line of credit that ballooned and was due, and it had not been properly considered when the person was doing their investing. They had to liquidate other investments, and it cost them a lot of money, a lot more than the interest on the line of credit, to liquidate the investments and then pay off that line of credit. So think about your position with regard to debt before you invest, and it will make you a better investor. Because the other thing is, when you've got that debt and you're investing, you've kind of got these two things on your mind, and you look at that debt and say, okay, I owe that, I want to pay that off, but I'm trying to invest, I'm trying to grow. And let's say we have another stock market correction, which, by the way, about every 12 months is how often we have a stock market correction over the last 100 years. So it's not an infrequent thing. So what happens, or how would you think if the stock market goes down 10 or 20% and you've got that debt? It might cause us to say, wait a minute, I want to liquidate my investments. I really can't lose it because I got that debt. So you see how that can kind of cloud your judgment and get in the way? So the debt is an important thing to tackle. Now, the fourth thing I want to talk about is not really a financial or investing thing, but what it is getting your legal affairs in order. Okay, so this is also very important. You need to have certain documents in place to protect your finances and your situation. There are several that are important, but there's a couple that are really key that I want to focus on. Power of attorney. It's a legal document that you sign that's executed with the assistance of an attorney that will give somebody else the ability to step in and pay your bills or handle your finances or address a legal issue when you can't. So let me give you an example. Let's say that you're in an automobile accident and you are laid up in the hospital. Maybe you can't really communicate well. You're not competent. You're not able to act on your own. Somebody else with that power of attorney, that legal document, can step in and manage your finances. Pay those credit cards that need to be paid. Make sure your mortgage is paid. Make sure that all your obligations are met and that you aren't getting late notices or having interest compound or having other repercussions, having the bank foreclose on your home. All these extreme things that probably aren't likely, but it gets you thinking about this. The other thing is, what if in this hypothetical accident, knock on wood, that never happens, what if there's a lawsuit that needs to be addressed? Power of attorney can step in and help. So here's the point. What's the good of having an investment portfolio if you don't have the proper legal things in place to protect you? And the same goes for a will, having a will. I mean, if you don't use the money and you want it to go to the people that you care most about, or the charities or other things that are important to you, You've worked really hard to grow and invest your money, but then you don't have the proper things in place to see it through, see it to go to the right people. What's the point of investing if somebody's going to inherit that money and it's all going to be blown, or they are subject to influence by somebody else that's going to help them blow it, or it's going to mess up their life, even though people think that money helps. In some cases it doesn't. Maybe you need a trust. So these financial documents are really important to have in place. Okay? So those are the big ones. Have a cash emergency fund. Make sure you've got age-appropriate insurances. Make sure you tackle your debt. Make sure you have the proper legal documents. There's 4. And one more. Here's a bonus one for you. Before you invest, if you are working, if you're in your working years, and you are not maxing out the 401k, 403b, or whatever other type of retirement plan that you have available to you through work, that's the first place to start. You say, well, I'm putting in the 3% that they'll match, but I want to invest other money somewhere else. Okay, I like diversification, and I also like having some money that is in 401ks and some money that's in regular money, but max out that 401k. Have it deducted from your paycheck. Max that out first before you invest in other alternatives. And if you are approaching retirement, make sure that before you go taking a lot of risk, that you've got enough money that is set aside in secure places that is going to give you that reliable income. In other words, don't gamble with money that you need to give you income tomorrow and the next day. So when we think about investing, it needs to be in the context of this overall plan that I've described to you. And if you do those things, I think it will help you plan much, much stronger. All right, it's time for viewer questions. So, this just in. No, not really, but it's a great question, and I had Larry ask me this question. He emailed it to me, and as I said on previous shows, if you email your questions to me, I can answer them. And I will always make sure that I change your name, and I change the scenario a little bit to make sure that it'd be hard to figure out who you are. Okay, so feel free to send your emails to me and I'll answer your questions. So let me read Larry's question. So Larry asks, or he states a part of it and then he asked me the question. I am familiar with the investing strategy called dollar cost averaging. I've benefited from this strategy while saving for my retirement years. Now that I am retired, I am aware that taking the same dollar amount each month out of a stock-based mutual fund works against me, or could work against me, I suppose. I have never seen an explicit strategy to avoid this problem that you call dollar cost ravaging. I've turned 70 and a half, and I need to take required minimum distributions, RMDs, from my IRAs. Some of my IRA money is in CD, and some of it's in stock. What do you suggest? Well, it's a very good question, Larry. So the first thing let's talk about, let me break this question into a couple of pieces. Number one, let's look at the concept of dollar cost averaging versus other thing called dollar cost ravaging. Dollar cost averaging is when you systematically put money into an investment. A lot of people do it during their working years with their 401k or other similar type of retirement plan at work. The idea is as you're putting in a set dollar amount, if it's $100 a paycheck or whatever it is, when the stock market goes up, you're buying fewer shares. When the stock market goes down, you're buying more shares for that same $100. And over time, what that does is it causes you to buy more shares when the market is quote-unquote cheaper than when it's more expensive, so that you end up buying at a lower cost. That's the concept. And for a lot of people, that has worked very well. It's not a perfect strategy. There's no perfect strategy, but it's contributed a lot to people's retirement accumulation of money. Now, the other thing that Larry mentioned in his email question is dollar cost ravaging. Now, that's actually a term I came up with. I'm sure there are other people that maybe have come up with the same term, but dollar cost ravaging is putting dollar cost averaging in reverse. What is that? Let me explain. When you are retired and you take a set dollar amount each month or however you take the money out, when the stock market goes up, you have to liquidate fewer shares to get the same amount of money. That's a good thing. But when the stock market goes down, you have to sell more shares to get the same amount of money. That's a bad thing. So remember back to 2008 when the stock market overall went down about 40%. If you were taking $1,000 a month from your investment account, you'd have to liquidate more shares to get the same $1,000. And are you liquidating at a good time or bad time? You know the answer. Bad time to be liquidating more shares. So it has this compound negative effect. So Larry's question is, I get that. How do I avoid it? How do I put the wheels on the pavement? So he's right now, in Larry's question, Larry is investing in the stock market and also in CDs. 2 thumbs up, Larry, for not having all of your money in the stock market when you're retired. That is inappropriate for most investors. Some maybe, but for most not. I love the idea of having some money safe and some money still growing, and here's why. Larry needs to take his required minimum distributions. At 70 and a half, you've got to start drawing from your IRA, 401k, 403b, all of these accounts that you've never drawn on, you have to now start. The IRS, the Treasury Department makes you start drawing. Why? Because they want to tax it. It's not that complicated. They want you to get a 1099, so you have to show that on your tax return and pay the tax on your IRA. You can't let it grow forever without drawing on it. So that percentage or that amount of money at 70 and a half is about 3.5% of your IRA balance. Your total qualified money, IRAs, 401ks, 403bs, all of that jazz, okay? All of that money times 3.5% is what you're required to take. Larry has about $300,000 in IRA money invested in stocks and CDs. The geography doesn't matter between CDs and the stocks. It's the total number that matters. So if you take 3.5% of $300,000, it's a little over $10,000. The IRS doesn't care where you're going to draw that $10,000. So the strategy here to avoid dollar cost ravaging is to avoid drawing that from the stock market. So it's a simple choice. In Larry's situation, he would draw his $10,000 from the CD money and let the other money, the stock money, continue to do what the stock market does, go up and down, but hopefully grow and continue to accumulate while not having to draw money out of it. Each year, the required minimum distribution has to be taken. And just to keep it interesting, each year that amount goes up. What? Every year, that percentage you're required to take, according to an IRS table, increases. So it goes from 3.5%, 3.75%, 4%. It goes up as you go up. As you get older, it's a larger percentage you're required to take out. But if Larry follows this strategy of taking from his CD money, he's giving himself a better chance of not having to take money out of the stocks while they're down and allow those stock funds to go back up if they do experience a decline. So, love the question. It handles so many aspects to this whole thing about retirement. Now, it doesn't have to be stocks and CDs. That's just, in Larry's case, what he was doing. It's a good example, but there are a lot of other things you can do. You can have a diversified portfolio for your investment fund that might include stocks and bonds, mutual funds, a whole host of different types of investing. And then for the safe money, you might want to use CDs, money market, other types of fixed accounts, maybe a fixed annuity, an index annuity. So you don't have to strictly follow the strategy I'm describing, but it gives you a good overview of what you can do. So those are your options. So look at those kind of things, and I think that'll serve you very well. One more thing before we go. It's your money, right? It's your money. You've worked hard, you've saved, you've accumulated, and you're hoping to have a great retirement someday. Or if you're already retired, make sure it lasts and is as wonderful as it can be. Don't be afraid to ask questions about how your money's being managed. Don't be afraid to get a second opinion if you're not sure your money's being handled as well as it can be. You know, we all like to think that everyone can do a great job at whatever it is they do. We have high hopes and expectations for other people. But sometimes things just don't get done right, or they're maybe not the best for you. It's okay to have a second opinion, to get another look, to make sure it's the best it can be for your situation. And if you do that, I'm confident you will plan stronger.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.